Howdy, boys and girls. Welcome to the weekly economic update for Monday, March 7th, 2022. I hope everybody out there in the interwebs had a wonderful weekend. It was kind of gloomy and gross here. Nothing but gray skies Saturday and Sunday and most of today. We got a little bit of snow. Most of it's melting off the driveway right now, which I am more than happy to just let it melt rather than have to go out there and scrape it up. But in a little bit, I'll have to go out and at least clear off the sidewalk and stuff so no one trips and breaks their neck walking up to the front door or anything like that. So, but anyways, like I said, I hope everyone had a good weekend. As far as sports-wise, my Cougars lost yesterday to Memphis, last game of the regular season, but they finished first place in the American Conference, which is good. Go Cougs. And they're headed off to the American Conference tournament. I think their first game will probably be on Friday. I think it starts Thursday, but they have a high seed, so they're going to get to skip the first game. So for any Cougar fans out there, that is certainly good news. Let's wish them some good luck heading into March Madness, which is, kind of my nirvana time of the year especially the first week of March Madness, Thursday, Friday, Saturday, Sunday. I will probably not get off the couch a whole lot. I'll probably take my laptop upstairs and work from the couch. Not that I don't have a TV here in my office, but it's much more fun to watch games on a 75, 80-inch television. So, all right. Well, y'all didn't come here to listen to me talk about sports. So if it's your first time watching, please click. There's probably a subscribe button if you're watching on YouTube. And if you're watching on Facebook, click the like button and please share with friends and family. That's how the word gets spread around, especially with everything that's going on in the economy and the markets, just political crap that's going on globally. I'll try to give you what my take is on things and try to, if I'm not talking about it, it's probably not very important. So, all right, well, let's go ahead and jump in to see how the indexes did today. Here, bigger for you. All right. Dow Jones was down 2.37%, closing at 32,817. S&P 500 down 2.95, closed at 4201. NASDAQ down 3.62%, closing at 12,830. Small caps are down 2%. The VIX was up 13.98% today. It's at 3645. So for the people who are my VIX watchers out there who really pay attention to that, anything over 30 is really bad, and we're sitting at a 36. So, if you look at the head near my thumbnail for the video, one of my bullet points is, our equities getting ready to capitulate. Could be, I'll show you some chart information in a few minutes that may, we may be there. So it's a little too early to tell. But, some of my charts are telling me we're headed into some bad news. Excuse me. Nothing but red from Canada, South America, Eastern Europe. Red, red, red. Got one green here in Portugal, but more red until we get down to Denmark. They were up. The Russian markets are closed again. It's been over a full week. Let's see. We got a couple greens here. What is this? What countries? Poland, Turkey, and Saudi Arabia, and then nothing but red the rest of the way. The Australian, New Zealand markets were down, or New Zealand was flat, or it was closed. All the Asian markets down 2-3%, all the way down to the bottom. So really nothing good for trading day, March 7th. Unfortunately, it looks pretty ugly right now. So, and this is the Dow. So what I'm looking at here, and if we zoom in, if we're looking in this area right here where my mouse is, you can see the MACD indicator, which is a momentum indicator of whatever security you're looking at. It has we had the cross back at the end of January, but it had really been hugging this line. It hadn't really had a significant drop. Let me scroll back out, and we can see 2 years ago, when it blasts through this line and continue, you don't have a crossover of the the trailing indicator with the leading indicator. We're headed for some bad times. And what this histogram shows is where that flip occurs. So you can see right there where the green crossed over the red here, you can see it very, very clearly on the histogram. So what like I said, zooming back in, we didn't continue to have an upside or the leading indicator continuing to fall. We did have a cross back up here in the beginning of February. So again, I was holding off on making any major changes to portfolios, but as this trend continues to drop, we haven't seen any red or any green coming back here on the histogram portion in a while. So, and just with everything coming up, I've decided to start making some changes and reducing some equity exposures. Now, if this tide changes, I'll flip it back on and add the equities back into the portfolios. But for the time being, be careful out there, folks. I was in this business 16 years ago, or 50, well, I guess it was 13, 14 years ago when the last time the market turned, but I was a wet behind the ears financial advisor at the time. And, listened to a lot of smart people around me at the time and survived it fairly well. But, I think things are going to get a little ugly heading forward. So, all right, well, let's go ahead and take a look at the weekly economic update. All right, the week on Wall Street, war in Ukraine weighed on stocks as investors assess the economic impact of continued hostilities, expanding economic sanctions, and potentially higher inflation due to rising oil prices. And new stresses on global supply chain. The Dow Industrial Average fell 1.3% last week. The S&P lost 1.27. The NASDAQ slid 2.78, and internationals dropped 3.21. All right, another volatile week. The uncertainty introduced from Russia's invasion continued to whipsaw the financial markets last week, intensifying hostilities early in the week. Sent stocks sharply lower as oil prices surged and flight to safety drove investors to buy bonds. Stocks rebounded midweek following the release of positive economic data and congressional testimony by Fed Chair Jerome Powell, who said the Fed is likely to move forward on rate hikes, but would proceed cautiously. Investor enthusiasm was short-lived, however, as stocks resumed their decline on Thursday into Friday despite a strong employment report. Powell testifies. Fed Chair Powell told Congress on Wednesday he would propose a 25 basis point increase in the federal funds rate when the FOMC meeting meets in mid-March. That's next week. He conceded that the invasion of Ukraine and the economic sanctions against Russia introduced a level of uncertainty and that the Fed would proceed carefully with monetary tightening. Powell also testified that he would not have the Fed's strategy to shrink its balance sheet finalized before the mid-March meeting, alluding to the urgency of fighting inflation. Powell left the door open to more aggressive rate hikes later in the year. See, here's the thing. How does he not have his homework done in order to start shrinking the balance sheet? I mean, we've known that this needs to occur for months, a year. I mean, seriously. It's just like he showed up and, my dog ate my homework. It's just BS is what it is. All right. So economic data coming out this week. We got the job openings and labor turnover survey, the JOLTS report. Thursday, consumer price index and jobless claims. Friday, consumer sentiments. We have a light week of earnings this week. Tomorrow we have Guidewire Software. Wednesday is Asana Inc. And Thursday we have JD.com, Ulta Beauty, DocuSign, and Rivian Automotive. All righty. So let's go ahead and take a look at the monthly economic update. I'm going to breeze through this since we probably covered a lot of this over the weeks. But for those who are on my mailing list, you get this in your email every week. So let's see if there's anything of importance here. The buildup of Russian troops on the Ukrainian border dominated the market last month, even before it culminated in the late February invasion. I wouldn't go so far to call it an invasion. But volatile stock prices turned lower as hopes for a diplomatic solution faded over the course of the month. The SP 500 index fell into correction territory. That is something to pay attention to. On the eve of the invasion, as investors woke up to learn that the invasion was underway, stocks suffered steep declines in early trading. We already know all that stuff. Let's see here. The sector scorecard, except for energy, which was up 7.07%, all industry sectors closed the month with losses, including communications down 7.44%, consumer discretionary down 4.07%, consumer staples down 1.41%, financials down 1.38%, healthcare down 0.97%, industrials down 0.84%, materials down 1.27%, real estate down 4.8%, Technology down 4.88, and utilities down 1.91. So again, with the market slowing down, a lot of the worries that are going on globally, to see that energy, which is something we all consume, and if certain people are spending more energy to go blow up other people, there's going to be less gas and energy for the rest of us. So it's not really shocking that energy did really well. All right. So what investors may be talking about in March? The FOMC meeting on March 15th and 16th. The Fed is expected to announce its first of several federal fund rate hikes in 2022 and provide greater clarity on its money tightening plans. While the market consensus is that the Fed will hike interest rates by 0.25%, the Russian invasion of Ukraine has added a layer of uncertainty. Raphael Bostic, president of the Federal Reserve Bank of Atlanta, commented in late January interview that the Fed has not ruled out a 50 basis point hike. In the past, markets have reacted to FOMC meeting updates and follow-up remarks made by Fed Chair Jerome Powell at post-meeting press conferences. March may be no different. All right, so let's see the Fed. All right, that's everything I got for there. So let's jump into two white papers I got going out this week. The first one is how market cycles can impact retirements. A thoughtful retirement strategy may help you pursue your many retirement goals. That strategy may consider many factors, and here are just a few: your income needs, the order of your withdrawals from taxable and tax-advantaged retirement accounts, the income tax implications of those withdrawals, and the sequence of return risk. Just what is the sequence of return risk? In brief, it's the risk that it is the risk that market declines in the early years of retirement combined with steady withdrawals could reduce your portfolio's outlook. A recent CNBC article mentioned how a sequence of return risk can affect retirement accounts. It used a 20-year example. Someone retiring in 2000 with $1 million in an account tracking the returns of the S&P 500, making withdrawals of $40,000 a year. That increased 2% annually in view of inflation. In 2000, a bear market began. The 37% pullback for the S&P 500 that occurred in 2000 through 2002 would have reduced the $1 million account to $470,000 by January 1st of by 2020, the end of the 20-year period. The balance reflects the annual withdrawals of $40,000 and the 2009 through 2020 bull market. Now, if the order of yearly returns were flipped, the portfolio would show much different performance. At the end of the 20-year period, the retiree would have more than $2.3 million in the account after the exact same schedule of income distributions. It's critical to point out that investing involves risk, and past performance does not guarantee future results. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. The S&P 500 composite is an unmanaged. Yeah, we already know that. All right. So basically, and again, this is something I evaluate with folks who are taking withdrawals from their accounts. You don't want to spend too much, especially during bad years. Sometimes you got to, live a little leaner, or during good years, maybe we take a little bit more out, sock it aside for a rainy day. So it's always a work in progress. There are no perfect financial plans, just because, life isn't perfect. I mean, like I've been telling people for the last, decade and a half, my job is to plan for the worst and hope for the best. And life usually falls between those two polar opposites. So, it's never going to be completely perfect. I mean, yes, some things just work out all well for everybody, for some people, but for most people, you have layoffs, you have, health issues, car breaks down. If you live somewhere hot like Houston, your air conditioner dies in July. So, I mean, there's just the unexpected is going to happen. And, that's the one thing we can plan for, is something unexpected is going to occur somewhere along your life plan. So, all right. Next white paper, getting mentally ready to retire. A successful retirement is not merely measured in financial terms. Even those who retire with small fortunes can face boredom or depression and the fear of drawing down their savings too fast. How can new retirees try to calm these worries? Two factors may help: a gradual retirement transition and some guidance from a financial professional. I know a guy. Call me, I'll hook you up. An abrupt break from the workplace may be unsettling. As a hypothetical example, imagine a well-paid finance manager at an auto dealership whose personal identity is closely tied to his job. His best friends are all at the dealership. He retires, and suddenly his friends his friends and sense of purpose are absent. He finds he has no compelling reason to leave the house and nothing to look forward to when he gets up in the morning. Guess what? He hates being retired. On the other hand, if he prepares for retirement years in advance of his farewell party by exploring an encore career, engaging in varieties of self-employment, or volunteering, he can retire with something promising ahead of him. If he broadens the scope of his social life so that he can see friends and family regularly and interact with both older and younger people in different settings, his retirement may also become more enjoyable. The interests and needs of a retiree can change with age as he or she disengages from the working world. Retired households may need to adjust their lifestyles in response to this evolution. Practically all retirees have some financial anxiety. It relates to the fact they're of no longer earning a conventional paycheck. You see it in couples who have $60,000 saved for retirement, and you see it for couples who have $6 million saved for retirement. Their retirement strategies are about to be tested in real time. All that careful preparation is ready to come to fruition, but there are always unknowns. Some retirees are afraid to spend. They fear spending too much too soon. With help from a financial professional, they can create a strategy. Retirement challenges people in two ways. The obvious challenge is financial. The less obvious challenge is mental. Both tests may be met with sufficient foresight and dedication. So that is definitely true. I've talked about my grandparents a lot through the years, where they were some of the busiest people. My granddad retired right before I left for the Navy, and so that was end of '92-ish, somewhere around there, and maybe the summer of '92. But I left for boot camp in May of '93, and he was retired by then. And they were some of the busiest folks in the world. I remember we would. When we'd come back into town, when we lived in Jacksonville, we'd have to call ahead to see if they're even going to be home and come by with the kids and stuff. So, granted, when they got to their 80s, they weren't out cavorting around town so much. But staying busy is super important. Whether or not it's like in my grandparents' case, the Elks Lodge and being part of the city council in the little town they lived in, or you got to stay busy. And staying active keeps your mind busy, or your mind active. And, it keeps you thinking and keeps you sharp. And the 20 plus years that they spend in retirement, pretty good. Other than a few health hiccups here and there, they had a pretty good retirement years. So, all right. So let's go ahead and cover this article. It's the kind of the daily recap in the stock market. S&P 500 slumps on fears war-fueled inflation to dent global economy, written by Yassine Ibrahim from Investing. The S&P 500 slumped Monday as the Russia-Ukraine conflict continued to push oil prices to 14-year highs, stoking fears that red-hot inflation will be here to stay longer than expected and derail economic growth. The third round of Ukraine-Russia talks ended with both sides indicating little progress had been made in search of a resolution to the conflict. The failure to reach a breakthrough heightened concerns about the economic impacts of soaring commodity prices, including wheat, corn, nickel, and oil. Oil prices topped their highest level since 2008 after the U.S. said it was mulling imposing a ban on Russia oil and gas. There's a hope the U.S. and Iran will reach a nuclear deal, bringing much-needed Iranian oil barrels into the market, but the potential supply from Islamic Republic isn't enough to offset the risk of loss of Russian oil. Well, if I could jump in here, we have tons of oil in Alaska, the Permian Basin. There's another one in the Midwest somewhere. The name is escaping me right now. We have plenty of oil here. If we would just get rid of all the damn regulations that our idiot government imposes, we would have cheap oil and cheap gas. But the idiots who hold on to their windmills and their unicorn farts to energize their electric cars, this is a perfect example of why we're not ready to make the jump to, electric vehicles solely. It's just, we're not there. So anyways, Iran could export up to 2.5 million barrels of crude oil per day, but yet Russian crude oil exports total 4.6 million barrels per day. Camara Bank said in a note, surging oil price hurt airline stocks as higher fuel costs are expected to weigh on growth. Delta Airlines, American Airlines, and United Airlines suffered heavy losses. Consumer discretionary stocks were the biggest sector decliners, led by U.S. luxury fashion and apparel stocks, on concerns that weaker investor sentiment in Europe will weigh on growth. Oh, people aren't going to be able to buy their fancy clothes? That's terrible. Tapestry, Ralph Lauren, and PVH were sharply lower, with the latter down more than 15%. Wedbush downgraded Ralph Lauren and PVH to neutral from outperform, as both companies are very reliant on European growth, which will likely take a hit from the Ukraine-Russia conflict. The selling in bank stocks showed no sign of end. Regional banks, including Synchrony Financial and SVB Financial and Signature Bank, continued to take a hammering, while mega cap banks such as Bank of America, Wells Fargo were also deeply in the red. In other news, Bed Bath & Beyond surged more than 37% after GameStop's chairman Ryan Cohen said the retailer should consider a sale and a spinoff of its Bye Bye Baby chain. I'm not familiar with that. Cohen has nearly a 10% stake in Bed Bath & Beyond. Mandiant surged more than 16% on reports that Alphabet is reportedly in talks to acquire the cybersecurity firm. The broader market, which has slipped deeper into correction, a more than 10% loss from its recent peak, appears to be trying to find the bottom. Small caps are starting to bottom, a positive sign that the U.S. equity markets in general are searching for some type of bottom in earnest. Janie Montgomery Scott, but added that this does not necessarily preclude more volatility ahead. That is probably true. Oop, I didn't have it up on the screen, so oops, sorry. All righty, last article I got here is from First Trust Financial, written by Brian Westbury. It's titled, "Will Russian Sanctions Lead China to Sell U.S. Debt?" Now, this is a big problem. And I've heard a number of people out there say, well, what if half the world decides to stop using the U.S. dollar for transactions? That could be a big problem, especially if China and Russia, if China sides with Russia, this could be very, very bad for the dollar. I personally think the dollar is going to crash at some point in the next decade anyway. So we'll have some new currency, whether or not it's using Bitcoin or Monero or something else. I just don't see the U.S. dollar being around in, by 2030. All right, let's dive into this. Russia's invasion of Ukraine led Western nations to impose the most draconian economic sanctions in the modern era. The Russian stock and bond markets have collapsed, along with Russia's currency, the ruble. Many investors fear China, which has always wanted control of Taiwan, will use the mayhem of the moment to take it. Obviously, this would create even more uncertainty and mayhem, but China is more involved in global finance than Russia. The West's response to Russia has not gone unnoticed, but many fear that even if China doesn't invade, it may preemptively sell its roughly $1.1 trillion in U.S. government debt to avoid financial retaliation. The fear is that this will cause U.S. interest rates to soar and the U.S. economy to suffer. We think this fear is unwarranted. Yes, inflation and the Fed tightening are likely to push rates up in the next few years. This is what the markets should focus on, not a Chinese sell-off of U.S. Treasury debt, which would have little impact. First, total U.S. debt is roughly $30 trillion. If China sold all of its debt, it's only 3.6% of all outstanding U.S. debt. A shock to the system maybe on the day it happens, but just a temporary shock, not a death blow. Second, consider what's happened to our budget deficit the last couple of years. Right before COVID, the Congressional Budget Office estimated that the baseline deficits for fiscal years 2020 and 2021 combined would be a two-year total of $2 trillion. Instead, due to COVID and related shutdowns, the two-year deficit totaled $5.9 trillion. That's $3.9 trillion in extra deficit over a two-year period, and the 10-year yield is essentially where it was right before COVID hit. Third, the Federal Reserve shrunk its balance sheet by almost $700 billion, effectively selling debt securities in 2018 and the first 8 months of 2019. Guess what? Interest rates fell. Fourth, even if rates were to rise, which looks likely no matter what China does, the U.S. economy has rarely been as insensitive to interest rates as it is today, due to underbuilding going back a decade. There are few new homes in the U.S. Even if mortgage rates go up, we need more new homes. Higher interest rates might mean a greater appetite for renting versus buying, but rental units have to be built too. Meanwhile, auto sales are very low due to supply chain issues. As those issues gradually get resolved, auto sales should increase even if interest rates go up. Fifth, we anticipate another round of quantitative tightening starting mid-year that will eventually be more aggressive than it was in 2018 and 19, maybe reducing the balance sheet by $100 billion per month. If we're right, this would mean 1 year of peak quantitative tightening by the Fed is even more debt being sold than all of debt China owns. And yet the 10-year yields is still 1.8%. We know the quantitative tightening isn't exact equivalent to China selling debt, but the comparison still puts the size of potential China sell-off in perspective. 6, it's important to remember that China didn't buy our debt as a favor to the US. They bought our debt out of self-interest. Using treasury debt to back their currency makes people more willing to use the renminbi. If China's government sells its treasury debt, that appetite for relative safety of the dollar won't disappear, and citizens in China could offset this sale by buying more dollar-denominated assets. 7th, the most important of all, we need to recognize that interest rates are a function of economic fundamentals and expectations about the future, not who is buying and selling how much treasury debt on a particular day. If China sells its treasury debt, it's going to end up getting dollars in return. What will it do with those dollars? Swap them for a different currency, let's say euros. Then whomever it swaps with will have the dollars. What will they do with those dollars? If China's sales of bonds drive up rates, whoever gets the dollars would likely turn around and buy U.S. bonds. The result, no fewer dollars or bonds in the world. U.S. debt that China owns is more problematic for China than it is for the U.S. Moreover, if China sells U.S. debt because it fears sanctions, then it will likely sell European debt as well. In the end, it's not the U.S. that has a problematic conundrum. China invading Taiwan would be a horrible event, but the fear that China hurting the economy by selling our debt is overblown. I would agree with that. I don't think our debt necessarily is the problem, since over the years people say, "Oh, China owns the United States." Well, yeah, they own a small portion of our debt. It's not like, but granted, they do own a lot of our supply chain because so much of it comes from China. So all those goods we get from China, they do kind of have us over a barrel there. What I was talking about when I first started out this article was, if China got a hair up their butt and decided, hey, we don't want to use the U.S. dollar anymore, that would have huge effects throughout the world. So it's not beyond the realm of possibility if Russia and China and some other nations, India, who aren't necessarily aligned with us, were to decide, hey, you know what, we're just done using the dollar. It's too volatile. There's the American government and the Fed have far too many problems. We're just going to separate ourselves from that. If other countries decide to stop using the dollar to purchase oil, the petrodollar, essentially, that again could lead to bigger problems. So, I mean, we have it pretty good right now because of the petrodollar and because the dollar is basically the reserve currency for the world. But if countries decide, hey, there's just too much risk in holding dollars and we don't want to really play their game anymore, we could really be in for a world of hurt. So again, a lot of this is speculation, but I'm always trying to think 10 steps ahead and where things may be going. So, all right, well, that's everything I had for today. And hey, I kept it under 30 minutes. I can't believe it. And I even know you had a couple of articles. So anyways, all right. Well, hope everyone has a great Monday evening, and I'll be back tomorrow with the Liberty Call. And if anyone needs anything from me, do not hesitate to reach out via email or give me a phone call. And I'll see y'all tomorrow. Bye.